Good morning. I'm Mehdi Sunderji, and welcome to OETV's Crypto Dome. We are here with Adam Blumberg, co-founder at Interaxis. Adam, how are you today?
I'm good. All things considered, I'm good,
All
man.
right, well, that's good to hear.
Yeah, we always say right at the beginning, right? There's always something to talk about with crypto, and this is a pretty big something.
This is a pretty big something. I thought, we'll mix things up a little bit today rather than going through, whatever other headlines there are. Listen, there's only one topic of conversation at this point. We've seen the last 24, 48 hours, most crypto assets have, I don't want to use the word vomit, but they've come off recent levels quite
We'll say they
aggressively.
they have violently sold off. How about that?
That's what I was looking for, and I just kept having the visual of vomit. But yeah, they've violently come off recent levels. We've seen, we've got Bitcoin trading, 70, it got low 17,000s. Ethereum's off 20% in 24 hours. Everything, it's pretty, I would describe this as carnage, right? So we have the main headline obviously being that Binance is buying FTX. FTX obviously founded and managed and run by Sam Bankman-Fried. There's a couple of things to unpackage here, right? It's FTX for last several months we've been in this so-called crypto winter. Sam Bankman-Fried has been a face of the positive side of crypto for during that period. He's been working with regulators on how we can better regulate things in the crypto asset world. He's been helping bail out a lot of small and mid-sized crypto firms along the way that have been in financial difficulties and have had liquidity issues. Now it turns out he himself and FTX have been in a similar liquidity crunch with their relationship with Alameda, and you can, I'll let you break down all this scenario as well. But yeah, where are we? This is like just possibly, to me, this seems like the worst thing that's happened in crypto.
Well, I think I'm trying to place everything right, and it's hard to go. This is the worst, or this is the best, or this. It is without a doubt the most shocking thing that has happened. And part of the shock is the speed at which it has happened, and part of it is obviously the people involved. So I think it's definitely the most shocking. Whether or not it's the worst, I don't know. I've been around since 2017, and it's probably, I guess, the worst, just because of where we are in terms of the amount of money going in, plus where we were trying to go with regulation, and kind of making a little bit of headway with regard to clarity. And Sam Bankman-Fried was at the forefront of that. Now, I wasn't a huge fan of the way he was going about it, but he was at the forefront. He was someone who had seemingly come out unscathed and even better off after the Terra Luna collapse, which led to Celsius and Voyager and BlockFi coming down, and he had seemed to come out unscathed, even helping out and buying those companies. And I think to regulators that seemed great, and like, we want to work with this guy. And turns out he's not a whole lot different.
So does this raise concerns that Sam Bankman-Fried was acting in a fraudulent capacity, or was there just a mishap? Like, what alarm bells go off in your head after reading what's happened over the last 48, 72 hours?
Well, several alarm bells, Matty. Do you want to go into kind of the chronology of what happened here? And
Let's go through the chronology down, made us saying, yeah.
Yeah. So, Sam Bankman-Fried, was obviously very young and very gifted and smart when he started Alameda Research, and he basically started it by finding arbitrage opportunities in Bitcoin. He was buying Bitcoin in the US and selling it in Japan and making 10%. And, I always tell people, look, a Bitcoin is a Bitcoin is a Bitcoin. So if you can buy it and sell it for 10% more immediately, that's a monster arbitrage opportunity. And so he started doing that, and then realized there were many more arbitrage opportunities in crypto, and started Alameda Research, or moved forward and grew Alameda Research into a monster hedge fund. And when those opportunities kind of dried up, when the arbitrage opportunities dried up, because more and more people with code got into the arbitrage, then he turned Alameda into a huge market maker. And in so doing, realized he wanted to create his own exchange, which became FTX, because he didn't like how the other exchanges worked for traders. So started FTX. And this is ironically where the two meet, he and CZ from Binance. And Binance actually was one of the first investors in FTX, which is interesting and ironic. But they were one of the first investors because Binance wasn't at the time really built for large traders, for traders that were trading large amounts. They were more for retail. And so FTX was going after traders worldwide. And so Binance invested. A few years later, they obviously became rivals in terms of the business, not necessarily rivals in personality, but rivals in terms of their businesses, where Binance was clearly number one in the world exchange, and FTX was floating somewhere between 2 and 4. And we don't know the exact numbers, remember, because they're centralized exchanges. We don't necessarily know everything that's going on, and we have to kind of trust what they say, which is ironic because we're talking about crypto, which is supposed to give this unbelievable amount of transparency. And in these situations, they just don't, there's just not a tremendous amount of transparency. So we're good so far. FTX is growing wildly. We've seen what Sam Bankman-Fried has done, and FTX logo is on Major League Baseball umpire uniforms, and it's all over ballparks, and they named a stadium, and he bought a esports team, and all of these things start happening with FTX growing wildly. And then there's celebrity endorsements and everything. And at some point, I think Binance and CZ decided on that front, they didn't want to own stock in FTX anymore. They didn't want to be an equity holder. So they decided to sell their equity stake and, back to FTX, and FTX basically gave them a whole bunch of FTT tokens. And FTT is the native token of the FTX exchange. And what it does is it gives traders the ability to get discounts on fees. And that's a big deal. If you're a big trader on FTX, then it's a big deal to get discounts on fees. And so they use that token for that. And therefore, the token has had a tremendous amount of value. In the meantime, of course, Sam Bankman-Fried and FTX have funded quite a bit in the Solana ecosystem. So they have quite a few Solana tokens. They have quite a few tokens for other, other decentralized exchanges or other applications that have been built mainly on the Solana ecosystem. And all those are, kind of being held with FTX and the fact that they made those investments. So all these kind of parts of the web, of this web are growing to show the outsized influence that FTX is having, plus, what Binance is seeing. So now Binance had like $2 billion worth of FTT tokens. And there wasn't a lot of liquidity for them because they weren't really traded all that much. They were more used by the FTX traders to get these discounts. So there wasn't a lot of trading capacity or liquidity. And apparently everything kind of came to a head. I mean, last week, I guess, or 2 weeks ago or sometime, SBF wrote, some Twitter threads and some information saying he was working with DC lawmakers on this DCCPA, the act that is hopefully in lawmakers' minds going to govern crypto more. And Sam Bankman-Fried was a big proponent of it. And a lot of those in DeFi said, no, this is horrible. Like, this is going to kill decentralized finance. And that's when those in the crypto world started to paint SBF as kind of the villain, saying, look, he's just trying to make himself better. He's trying to make centralized exchanges better at the expense of decentralized finance, which is kind of, in ethos terms, at the expense of what crypto is supposed to be. I want to make more money. I want the regulators to basically give me the green light to make more money. And I want to do that at the expense of DeFi, right? That's kind of what he was painted with at that point. As he was working with that, somehow word got to CZ that SBF was not saying very nice things to the regulators about Binance and saying they are an example of someone that should be more heavily regulated. Look at all these things that they're doing that are incorrect, that are wrong, that are fraudulent. CZ got word of that and I guess took offense to it. And these are just things that we're reading now, right? This has all happened in such a short amount of time. It's really hard for anything to be really validated and verified as much as we'd like. But what I've read is he kind of took offense to that and said, I don't want to own any part of you anymore. And because things are on chain, we saw there's something like $580 million worth of FTT tokens that got moved onto the Binance exchange, which and then basically CZ corroborated the story and said, I did that. That's us. We're starting to liquidate our FTT tokens. We don't want to be a part of what they're doing because of his work with regulators. And that, that sent everyone, scrambling for the doors. If Binance is going to liquidate $2 billion worth of FTT tokens, they are definitely going to plummet in value because there's very little liquidity, and everyone started running for the exits. And that in turn caused kind of a run on FTX, everyone trying to withdraw funds, because if the FTT token gets hit, we know that a huge portion of the FTX balance sheet is held in FTT tokens. Because again, I'll start with the web again. Just a few weeks ago, there was a report from CoinDesk that they got the Alameda Research balance sheet, and a tremendous amount of the Alameda Research balance sheet was held in FTT tokens, right? And it's unclear what the interplay is between FTX and Alameda Research. If user funds from FTX, if my deposited funds on the FTX exchange were loaned, were invested or something without my knowledge, and then when I go to withdraw, there's no money there for me to withdraw, that's a problem. It's not legal, number one. And number two, it's a huge problem because I have my money there and I expect them to keep it safe, and they're not doing that. So all of this happens, the FTT token collapses, which means so much of the loans that either FTX or Alameda Research had out there that were collateralized with FTT tokens start getting called. There's a run on FTX. And the next thing we know, as we're seeing that happen, the next thing we know, we get these messages on Twitter from SBF saying we have an agreement with Binance to help us, and CZ saying we're buying FTX.
Now, just to rewind there one moment on one of the statements you made, where if you've got your account with FTX and you go to withdraw your funds, and if your funds unknowingly had been lent to Alameda, right? You don't really, and this is one of the biggest issues why we want more regulation in the industry, you don't really have a leg to stand on.
No, at this point you don't. And this happened, Mehdi, you and I talked about this last year, or maybe early this year. I don't know. Coinbase came out with their annual report, or their quarterly report, remember? And there was this tiny little phrase in there that said, if you deposit crypto with us, if we're holding it for you, you are an unsecured creditor. It's essentially our money, and we're going to allow you to withdraw it if we so choose and if we have the funds. And that was a big problem that people had with Coinbase. Now, Coinbase has been, one, really good with risk management, right? Because Coinbase is not trying to go earn extra yield for themselves, right? What they're saying is we are here to be a middleman. We're here to be an exchange. We're here to be an on-off ramp. We're here to be a custodian. We are not here to make money in other ways. That's how we make our money. FTX, it seemed like, was trying to loan money, profit, whatever else, find other ways to earn money other than let's just be the best exchange we can be.
Well, FTX is, if you look at what FTX was doing, they were also trying to do what traditional banks do, is try and create revenue off their deposits, right? Which is a traditional financial systems helps their revenue base, right? Whereas Coinbase, as you say, has kind of stuck to, let's start on step one, let's get the custody right, let's get the exchange part right on off ramps, and we'll stick with that. Fantastic. That's a very clean model, and it makes your underlying customer much more comfortable in a universe where you don't have any regulatory cover on your deposits. FTX has gone into, and that kind of also almost explains the working closer with DC to try and not manipulate, but try and guide regulators to things that may be a bit more fitting with, one, traditional finance. Again, as they've said and indicated, we might be trying to force a square peg into an existing round hole, which doesn't necessarily fit with the DeFi mentality and what it stands for. But that's kind of the direction we seem to be edging towards. And I guess, Sam was on that side.
Right. And that's where you realize, okay, that I've been very, very much a proponent of allowing crypto to do what it's supposed to do and keeping some regulation, keeping too much regulation out of it. What we see though is the way banks are regulated, there's a reason for it, because in the absence of the regulation on banks, they do what they did in 2008, right? And because people are people and they're going to go to try to earn things. So basically there are two ways to go with this. On the one side, if you're going to be opaque, meaning if you're going to be a centralized entity and you're not going to open up your treasury or your balance sheet or your deposits to scrutiny 24/7, 365 all the time, we have to put rules on you because I can't see what's happening with my money when I deposit it. And therefore you have to have rules because we don't trust that you're doing what you're supposed to do. If on the other side, you look at decentralized finance, which is tremendously transparent, then maybe you shouldn't have as many rules because the rules are there to protect those when there's no transparency, right? The rules came about from after 2008 and the banking crisis to say, again, if we can't see what you're doing with the money, then here are the only things you're allowed to do with the money. This is it. If you do something else, then that's not legal. On the DeFi side, we see everything that's happening.
Adam, one of the things that I think people aren't necessarily talking about, and I think is quite important to highlight, is the fact that let's take a traditional bank. During a financial crisis, if there's a run on a bank, you go and you withdraw your dollars. I'm just talking US financial system today. Let's say every depositor at JP Morgan goes and withdraws their funds and it's a run on the bank. That's a big problem for JP Morgan. It's not necessarily a problem for the US dollar. We have two things at work here, right? We have deposits at FTX, and it's much easier, sorry, it's much more difficult to withdraw your, let's say, Bitcoin holdings from FTX and sit there and put your Bitcoin holdings under your mattress. You first have to go sell said Bitcoin and then withdraw your fiat currency, unless you go and put it onto a wallet or transfer it to another exchange or whatever. But for Joe Bloggs, who is concerned about their money in FTX, their first step, I would assume, would be to go sell and withdraw cash or fiat currency, US dollars. So now you've got two implications of that. It's not like the traditional financial system where JP Morgan, in our example, would be the one to be in trouble, right? The financial institution with the run on the bank, which is FTX in this case. We now have a secondary issue. That secondary issue is now the cryptocurrencies that are being sold are obviously losing their value because people are dumping that crypto to withdraw fiat currency. This is, again, it's completely away from the decentralization mentality of what should be happening with crypto finance. We should be able to just withdraw Bitcoin, stick it on your USB, walk over somewhere and dump it back onto another account, right? That should be the simplicity of how we can do it. But unfortunately, 9 out of 10, and I'm making these statistics up, I'm going to say 80, 90% of retail customers wouldn't necessarily go down the route of trying to figure out how to transfer their Bitcoin holdings to another wallet. They would just sell.
Right, but Mehdi, the problem here is it didn't matter, because what I have at FTX or what I have at any exchange technically is just an accounting entry that says, in theory, FTX or some other exchange, but I'll use FTX because they were the bad one. I don't want to sully anyone else's name. So FTX essentially has, if you use your example of Bitcoin, they have this monster wallet that has a whole bunch of Bitcoin in it, right? Theoretically. What they've said when I have an account is Adam owns 0.00001% of whatever's in this wallet. But then if they've gone and taken the Bitcoin that's in that wallet and gone and loaned it out or used it or invested it or something, then I own 0.00001% of nothing because there's nothing there, right? And it's not any different than my owning my having a deposit at JP Morgan or Chase Bank, right? Because it's the same thing. I have a digital representation of some piece of their assets that represents a certain number of dollars. The difference here is what FTX was doing is they were converting that. They were essentially acting like a bank. They were being like a fractional reserve bank, right? Except they were converting it to their own token. And the thought was there are always going to be so many traders. There's always going to be so much need for what we do. And that's how they were able to make it through this crypto winter, because everyone was still trading on FTX, right? Even when things were going down, they were making a whole bunch of money and there was an incentive to have the FTT token. And so that's one of the ways they were able to make it through. The frustrating part about this is if we look back at the companies he bailed out, they were doing the same thing. It was incredibly poor risk management. That's really what it was. It was just incredibly poor risk management. And now, like, we're not even close to seeing all the fallout from this.
So now that obviously leads nicely to the next question, right? What happens to the companies that FTX bailed out over the last several months?
Yeah, that's a really good question. Are they going to get lumped into the deal? Look, their assets aren't that much at this point. I mean, Sam was trying to buy them up, I'm guessing, just so he could have more assets under the FTX name and more traders and everything else. Now, remember also, Mehdi, this is really important. FTX also has FTX US, right, which is a separate entity. And FTX US did not have pauses in, as far as I understand, did not have pauses in withdrawals, right? This is a big part of the story. Is yesterday at some point, FTX started canceling or pausing withdrawals, meaning if I was trying to take crypto out, and a lot of people are trying to take it out in stable coins. If I was trying to take it out, they wouldn't let me withdraw anything. FTX US, as far as I know, didn't have that issue. And the reason is because they aren't allowed to go, they're not allowed to go invest user deposits, right? Whereas the large FTX worldwide, the FTX.com, doesn't play by the US rules.
Well, so that again, so we've just got a viewer question just came in, which actually fits in perfectly right here. It's from London Duck. I guess it's a duck based in London, which makes sense. Does this mean that Binance can end up with 80% market share? Surely this means that the government will finally get serious with regulation. So that kind of ties in, and before we get to it, he also has a second follow-up question saying, could there be anyone else to come in over the top for FTX? That's really interesting, right? So let's address the first part first. Would Binance end up with 80% of market share potential of all the crypto assets, and what does that mean for regulation?
Well, that's what I've read, is they would end up with roughly 80% of the worldwide market in terms of, and I don't know if that's in terms of dollar value or traders or number of accounts or anything like that. But Binance is huge in Asia, and it's huge in Europe, and it's huge in Africa and the Middle East. I mean, they're now headquartered, I think, in Dubai, and they're going after that market. So they're a monster that we in the US don't know as much about because we have Coinbase, and we have Gemini, and we have big exchanges like that. So yeah, they could end up with 80% of the worldwide market, which is not a good thing by any means.
And that's not going to let any regulators sit comfortable. And again, with this global situation, which regulatory body is going to get involved where and how, and are they going to talk to each other? On one hand, like one US entity can't talk to another US entity. It's ridiculous. How are we going to have that on a global basis? This has kind of been one of those situations.
And we're already seeing, the CFTC is already going to investigate this because they need to see if there's going to be an issue. Now, the CFTC really only has purview if they're talking about the US companies they have, because FTX has FTX US and Binance has Binance US. So if those are not involved, then I don't think the CFTC has any jurisdiction here, right? But they're going to pop their head out and say, we got to take a look at it. But if they might not have any jurisdiction here.
Now, that's an interesting point from our duck-like friend in London. That could someone come in over the top and throw in a bid for FTX? What about another financial institution, an existing financial institution? Could a JP Morgan come in and buy them? Could that be an interesting thing?
That would be incredibly interesting. Right now, the problem here is, remember, JP Morgan exists mostly in the US. And so, the question is there some entity outside of the US that would come in and buy FTX? And that's an interesting thought. Is there a financial institution, maybe one out of Singapore or Hong Kong or Dubai, that can come in and make a better offer? I did see yesterday where Yoni Assia, the founder of eToro, actually put out a tweet and said, hey, Sam, if you want a competing offer, give me a call. Right. So there's another worldwide crypto exchange that's a monster outside of the US that has publicly said, we'll jump in too.
That'd be interesting.
That would be really interesting to have kind of a bidding war for FTX after FTX has been the ones winning all the bidding for everything else.
And do you know what would be very interesting is if the Chinese came in to try and buy them and see how that sits with the regulators globally.
Chinese, right? Korea, you know, they all have funds now. You know, that doesn't mean that FTX has to sell to them.
No,
right? It's not like the largest bidder, but it would be really interesting to see who comes in. Look, I think it would be relatively exciting if some traditional finance company came in. And
I do as well, because I think that might actually help the cause speed up some of the rate, and it might not necessarily be all the right thing for crypto and everything if we have a financial institution picking up an asset like FTX, but I think it would help the cause on helping some form of structured guidelines around how to manage some of these assets versus what's been happening in the Wild West. It's the crypto world.
Exactly. And the problem there is it's not like traditional financial companies are having a good time right now. No. Like they're hurting, you know, like I had mentioned, international companies like Deutsche Bank, they're not doing well. Credit Suisse is having huge issues. So who else is going to, you know, worldwide is going to jump in?
Almost better than one financial institution could be like the top five come in as a conglomerate and they buy FTX as a gateway to crypto for like
but then we have to wonder, Mehdi, like, okay, what are they buying? What are the assets? Are they just buying the technology at that point? Are they just buying the trading? I mean,
accounts.
Like it would be interesting if it's just for the tech. To make better tech, then why doesn't this group that's Fidelity and Schwab and Virtu and all that just buy it and go, all right, well, you know, because they were going to create a crypto exchange.
Yeah.
Why don't they just buy that and say, we'll take this technology, we'll change it up to make it regulatory compliant in the US, and bam, like we'll launch our exchange in a week and a half.
And they'll have existing customer accounts, which they might be able to revitalize.
Exactly. So that might happen. Look, there's more fallout. We don't know how leveraged Alameda Research was. You know, just like we saw fallout later with Three Arrows Capital, and we realized that other companies had let them borrow money. What I have seen, because I got to find some bit of good news here, right? On the DeFi front, this gives so much more credence to this idea of decentralized finance, of transparency, of always knowing what the reserves are. Because there was a big deal where Sam Bankman-Fried said, our reserves are fine. And everyone said, all right, prove it. Open up the books and show us. And they never did. In crypto, in DeFi, they're always transparent. And so what I've seen is there's a protocol called Maple Finance that does quite a bit of kind of institutional lending in DeFi. And all of their underwriters, which they call pool delegates, have basically come out and said, we don't have a lot of exposure here. It's not, you know, most of our borrowers have no exposure. And it was all transparent. They've all, you know, and then they can show us too, they can prove it. Here's our exposure. Here's where we've lent money. And many of them said, we looked at lending to FTX or Alameda and we chose against it. We lent to them before, we loaned to them at one point, and we've chosen against it in the last several months. So they kind of knew too. They were able to look at the books and realize that. And so the kind of silver lining is decentralized finance makes more sense. If you're one of those people around the world, unfortunately, who is not able to get your funds out of FTX because they halted withdrawals, well, if you have your money in your own wallet, then there's no one that can halt your withdrawals, right? And that goes to what the ethos of crypto is supposed to be. It is not about, it's not supposed to be about how can I make more money. What it's supposed to be about is how can more people have access and opportunity to participate in the financial system. And unfortunately, it became, how can I make more money building that system? And then how can I make more money leveraging and trading on the system that I built to take advantage of the new ecosystem, right? Whereas it's supposed to be about more opportunity and transparency and everything that we still see from DeFi.
Well, there's going to be a lot more, you know, as you say, fallout over the next few days, weeks, months, who knows, years. Let's see how all this plays out, whether it is Binance, whether someone else comes in over the top. Let's, you know, lots to watch. But just on a positive note, while we've been talking, Bitcoin looks to be up about $6. So at least that's going in the right direction.
Well, it's going to take us a lot of talking then to get it back up to
20.
I mean, we're going to have to go on some sort of Gandhi-like marathon.
Well,
like a 40-day, you and I just sitting here talking and not eating kind of thing. But
starting next Wednesday, we'll be here live for 40 days.
give me a little time to carbo load or something.
There we go.
Maybe we can go for it.
Adam, as always, mate, thank you so much for sharing your thoughts from Interaxis about the world of crypto.
You're welcome, Mehdi. Good to be here.
And we'll see you next week. And everyone watching, thank you for watching and good luck investing.